Imagine you're 18 years old, holding your first paycheck, and suddenly realizing nobody ever taught you what to do with money. Should you save it? Invest it? What's a credit score? Why does everyone keep talking about compound interest like it's magic? Today, we're covering every essential financial concept that schools somehow forgot to teach you, but that will determine whether you retire wealthy or work until you die. Compound interest, the eighth wonder of the world. Albert Einstein allegedly called compound interest the eighth wonder of the world, saying, "He who understands it, earns it. He who doesn't, pays it." Whether Einstein actually said this doesn't matter. The principle is absolutely true and will either make you rich or keep you poor. Compound interest means earning interest on your interest. If you invest $1,000 at 10% annual return, you have $1,100 after year one. But in year two, you earn 10% on the full $1,100, giving you $1,210. That extra $10 came from earning interest on last year's interest. This seems small initially, but time transforms compound interest into a wealth-building machine. That same $1,000, left untouched for 40 years at 10% annual returns, becomes $45,259. You contributed $1,000, but compound interest contributed $44,259. The key insight: time matters more than amount. A 20-year-old who saves $2,000 per year for just 10 years and then stops will have more money at retirement than someone who saves $2,000 per year starting at age 30 and continues for 35 years. Starting early gives compound interest more time to work its magic. Most people underestimate compound interest power because humans think linearly, not exponentially. We see 10% growth and imagine steady, predictable increases. Reality is exponential acceleration that starts slowly but becomes overwhelming over decades. Such credit scores, your financial reputation number. Your credit score is a 3-digit number between 300 and 850 that determines whether you can buy a house, get a car loan, rent an apartment, or sometimes even get hired for certain jobs. It's your financial reputation distilled into mathematics. Credit scores measure how reliably you repay borrowed money. The scoring system considers 5 factors: payment history, 35%, credit utilization, 30%, length of credit history, 15%, types of credit, 10%, and new credit inquiries, 10%. Payment history is straightforward. Pay your bills on time, every time. Even one late payment can drop your score by 50 to 100 points and stay on your credit report for 7 years. Set up automatic payments for at least the minimum amount to avoid accidentally destroying your credit. Credit utilization measures how much of your available credit you're using. If you have a credit card with a $1,000 limit and carry a $500 balance, your utilization is 50%. Keep utilization below 30%, ideally below 10%. High utilization suggests you're struggling financially even if you pay on time. Building credit takes time, which creates a frustrating catch-22. You need credit history to get credit, but you need credit to build credit history. Start with a secured credit card, become an authorized user on a family member's account, or get a credit builder loan from a credit union. Emergency funds, your financial life jacket. An emergency fund is money set aside for unexpected expenses or income loss. This isn't money for vacations or shopping. It's for genuine emergencies like job loss, medical bills, car repairs, or home maintenance that insurance doesn't cover. Most financial experts recommend 3 to 6 months of living expenses in an easily accessible savings account. If your monthly expenses total $3,000, you need $9,000 to $18,000 in emergency savings. This might seem impossible, but it's absolutely essential for financial stability. Emergency funds prevent debt cycles that destroy wealth. Without emergency savings, unexpected expenses force you to use credit cards or loans, creating debt that compounds and grows. With emergency savings, unexpected expenses are annoying but not financially devastating. Start small if you're overwhelmed by the full amount. Save $500 first, then $1,000, then 1 month of expenses. Automate transfers to your emergency fund so saving happens without conscious effort. Treat emergency fund contributions like non-negotiable bills. Keep emergency funds in boring, safe accounts. High-yield savings accounts, money market accounts, or certificates of deposit work well. Don't invest emergency funds in stocks or risky assets. You might need this money when markets are down, forcing you to sell investments at losses. Budgeting, giving every dollar a purpose. Budgeting means intentionally deciding how to spend your money before you spend it. Without a budget, money disappears mysteriously, leaving you wondering where it all went. With a budget, every dollar has a specific purpose and you control your financial destiny. The 50-30-20 rule provides a simple starting framework. 50% of after-tax income for needs, 30% for wants, and 20% for savings and debt repayment. Needs include housing, food, transportation, insurance, and minimum debt payments. Wants include entertainment, dining out, hobbies, and non-essential shopping. Zero-based budgeting assigns every dollar a specific purpose until your income minus all planned expenses equals zero. This doesn't mean spending everything. Savings and investments count as expenses in your budget. The goal is intentional allocation rather than accidental spending. Track your spending for at least 1 month before creating a budget. Most people dramatically underestimate how much they spend on categories like food, entertainment, and miscellaneous purchases. Reality-based budgets work. Fantasy budgets don't. Use whatever tracking method you'll actually follow. Apps like Mint, YNAB, or EveryDollar work for some people. Others prefer spreadsheets or even paper and pencil. The best budgeting system is the one you'll use consistently for months and years. Debt management. Good debt versus bad debt. Not all debt is evil. Good debt helps you build wealth or increase earning potential. Bad debt drains wealth and keeps you financially stuck. Understanding the difference determines whether debt helps or hurts your financial future. Good debt includes mortgages, student loans for valuable degrees, and business loans that generate income. These debts typically offer tax benefits, relatively low interest rates, and help you acquire assets that appreciate in value or increase your earning capacity. Bad debt includes credit card debt for consumption, car loans, personal loans for vacations or luxury items, and any debt used to buy things that decrease in value. High interest rates and no tax benefits make bad debt wealth destroyers. The debt avalanche method pays minimum amounts on all debts while putting extra money toward the highest interest rate debt first. This saves the most money mathematically. The debt snowball method pays minimums on all debts while putting extra money toward the smallest balance first, creating psychological momentum. Credit card debt is the most dangerous common debt. Average credit card interest rates exceed 20% annually, making credit card debt nearly impossible to pay off while continuing to use the cards. Stop using credit cards entirely until balances are paid off. Investment basics. Making money work for you. Investing means buying assets that you expect to increase in value or generate income over time. While saving preserves money, investing grows money. Without investment returns, most people cannot accumulate enough wealth for financial independence or comfortable retirement. Stocks represent ownership in companies. When you buy Apple stock, you own a tiny piece of Apple and benefit from the company's success. Stocks historically return about 10% annually over long periods, but experience significant short-term volatility. Bonds are loans to governments or corporations. When you buy a bond, you lend money in exchange for regular interest payments and eventual return of your principal. Bonds typically offer lower returns than stocks but with less volatility. Mutual funds and exchange-traded funds pool money from many investors to buy diversified portfolios of stocks, bonds, or other assets. These funds allow small investors to achieve diversification impossible with individual stock picking. Index funds track market indices like the S&P 500, buying all companies in the index in proportion to their size. Index funds offer broad diversification, low fees, and historically strong returns. Most investors should build portfolios around low-cost index funds rather than trying to pick individual stocks. Start investing as early as possible, even with small amounts. Consistent monthly investing of $50 or $100 creates substantial wealth over decades through compound returns. Time in the market beats timing the market. Insurance, protecting what matters most. Insurance transfers financial risks you cannot afford to bear yourself. The purpose isn't to profit from insurance, but to protect against catastrophic losses that could destroy your financial progress. Health insurance protects against medical bankruptcies that affect even financially responsible people. Medical bills are the leading cause of personal bankruptcy in America. High-deductible health plans paired with health savings accounts often provide the best combination of protection and tax benefits. Life insurance replaces your income if you die prematurely. Term life insurance provides coverage for specific periods, 10, 20, or 30 years, and costs much less than permanent life insurance. Buy term life insurance if anyone depends on your income. Skip it if you're single with no dependents. Disability insurance replaces income if injury or illness prevents you from working. You're more likely to become disabled than die during your working years, making disability insurance more important than life insurance for most people. Many employers offer group disability coverage, but individual policies provide better protection. Auto insurance is legally required in most states and financially essential everywhere. Liability coverage protects others if you cause accidents. Comprehensive and collision coverage protect your vehicle. Carry enough liability coverage to protect your assets. Avoid insurance for minor risks you can afford to cover yourself. Extended warranties, credit life insurance, and insurance for electronics or appliances typically cost more than they're worth. Focus insurance spending on risks that could cause financial devastation. Tax fundamentals, keeping more of what you earn. Taxes consume 20 to 40% of most people's income, making tax efficiency crucial for wealth building. Understanding basic tax concepts helps you keep more of what you earn and make smarter financial decisions. Income taxes apply to wages, business income, interest, and dividends. Tax rates increase as income increases, creating marginal tax brackets. Your marginal tax rate is the percentage paid on your last dollar of income, while your effective tax rate is your total taxes divided by total income. Tax-deferred accounts, like traditional 401k plans and IRAs, reduce current taxes but create future tax obligations. Money contributed to these accounts isn't taxed today, but withdrawals in retirement are taxed as ordinary income. Tax-free accounts like Roth IRAs and Roth 401k plans are funded with after-tax money, but they grow tax-free forever. You pay taxes on contributions today, but never pay taxes on qualified withdrawals, including all growth and earnings. Capital gains taxes apply to profits from selling investments. Short-term capital gains, assets held less than 1 year, are taxed as ordinary income. Long-term capital gains, assets held more than 1 year, receive preferential tax rates, typically 0, 15, or 20% depending on income. Tax loss harvesting involves selling losing investments to offset gains from winning investments, reducing your tax bill. This strategy works in taxable investment accounts, but not in retirement accounts where gains and losses don't create immediate tax consequences. Retirement planning, your future self's financial security. Retirement planning means accumulating enough assets to maintain your desired lifestyle without working. This requires decades of consistent saving and investing, making early starts crucial for success. The rule of 25 suggests you need 25 times your annual expenses saved for retirement. If you spend $40,000 annually, you need $1 million saved. This assumes a 4% annual withdrawal rate that historically allows retirement savings to last 30 years or more. Employer-sponsored retirement plans like 401k plans offer powerful wealth-building opportunities. Many employers match contributions up to certain limits. This is free money you should never leave on the table. Contribute at least enough to receive the full employer match. Individual retirement accounts allow additional retirement savings beyond employer plans. Traditional IRAs offer current tax deductions but create future tax obligations. Roth IRAs provide no current deductions but offer tax-free growth and withdrawals. Social Security provides partial retirement income replacement, typically covering 30 to 40% of pre-retirement income for middle-class workers. Social Security benefits increase if you delay claiming past your full retirement age, up to age 70. Start retirement planning immediately, regardless of age. A 25-year-old who saves 10% of income will likely achieve financial independence. A 45-year-old starting retirement planning must save 25% or more of income to catch up. Building wealth. The psychology of money. Building wealth requires more than technical knowledge. It demands understanding the psychological aspects of money management. Emotions, Cognitive biases and social pressures often sabotage financially sound decisions. Lifestyle inflation destroys wealth accumulation. As income increases, people tend to increase spending proportionally, maintaining the same savings rate but missing opportunities to accelerate wealth building. Combat lifestyle inflation by automatically increasing savings rates when income increases. The hedonic treadmill explains why people making $100,000 don't feel twice as happy as people making $50,000. Humans adapt to higher spending levels quickly, returning to baseline happiness despite increased consumption. This adaptation makes additional spending less valuable than savings and investment. Social comparison drives poor financial decisions. Keeping up with neighbors, coworkers, or social media influences leads to overspending on status symbols rather than wealth-building assets. Focus on your financial goals rather than others' apparent prosperity. Delayed gratification is the fundamental wealth-building skill. The famous Stanford marshmallow experiment showed that children who could delay eating one marshmallow to receive 2 marshmallows later achieved greater success throughout life. Adults who can delay consumption to invest for the future build substantial wealth. Automation eliminates willpower dependence. Set up automatic transfers to savings and investment accounts immediately after payday. Pay yourself first before discretionary spending has a chance to consume available money. Financial independence, the ultimate goal. Financial independence means having enough assets to cover living expenses without working. This doesn't require extreme wealth. It requires living below your means and investing the difference consistently over time. The FIRE movement, Financial Independence Retire Early, has popularized aggressive savings rates of 50% or more to achieve financial independence by age 30 or 40. While extreme, FIRE demonstrates that financial independence is possible with sufficient savings rates and investment returns. Calculate your financial independence number using the rule of 25. Multiply annual expenses by 25. Someone spending $30,000 annually needs $750,000 invested. Someone spending $60,000 annually needs $1.5 million. Geographic arbitrage accelerates financial independence by earning income in high-cost areas while spending in low-cost areas. Remote work opportunities make geographic arbitrage more accessible, allowing people to maintain high salaries while reducing living expenses. Multiple income streams reduce financial independence risks. Relying solely on investment returns creates vulnerability to market downturns. Combining investment income with rental properties, business income, or part-time work provides greater security. Financial independence isn't about retiring to a beach, it's about having choices. Financially independent people can pursue meaningful work without worrying about paychecks, take career risks, or spend time on relationships and experiences rather than money worries. Understanding these financial concepts transforms your relationship with money from reactive to proactive. You move from wondering where money went to directing where money goes. You shift from financial anxiety to financial confidence. The journey requires patience, discipline, and consistent action over decades. But the destination, financial security, freedom from money worries, and the ability to pursue your goals without financial constraints, makes every sacrifice worthwhile. Start today, start small, but start. Your future self will thank you for every dollar saved, every investment made, and every financially intelligent decision you make today.